We always hear investor gurus saying how important it is to have a diverse portfolio. As a wise investor, it's crucial to understand the potential risk involved by putting all their eggs in one basket. Before you invest your money and construct an investment portfolio, it's critical to understand all of your alternatives as an investor. Number 1. The precious metal gold. You can invest in gold as well as other commodities like silver and crude oil. In truth, gold investing has a long history, but it doesn't necessarily indicate it's a good investment. Because gold is a commodity, its price is determined by scarcity and fear, which political or environmental effects can influence. If you buy in gold, keep in mind that your price protection, or moat, is dependent on external causes, which means the price might move a lot and quickly. When scarcity and fear are high, the price rises, and when scarcity and fear are low, the price falls. If you believe the world will become more afraid in the future, gold may be an excellent investment for you. Number 2. Bank products and CDs. Savings accounts and money market accounts, which are similar to savings accounts but often receive greater interest rates in exchange for higher balance requirements, are examples of bank products. Another form of bank instrument is a CD, which stands for Certificate Deposit. When you buy a CD, you agree to lend the bank money for a set period of time, plus interest. CDs are a very low-risk investment, but they also have a low return. Most banks provide CDs with an annual yield of less than 2%, which is barely enough to keep up with inflation. Number 3. Cryptocurrency. Cryptocurrencies are the newest type of investment. They are unregulated digital currencies bought and sold on cryptocurrency websites. Cryptocurrencies such as Bitcoin or Dogecoin have gained much interest in recent years as an investment vehicle. However, they remain an incredibly risky investment due to many unknown factors. There is the possibility of government regulation, and the possibility that cryptocurrency will never see widespread acceptance as a form of payment. Number 4. Savings bonds and corporate bonds in the United States. When you buy a bond, you're basically lending money to the company you're buying it from for a set period of time and interest. Bonds are considered safe and low-risk investments because the only way you can lose money is if the issuer defaults. Savings bonds in the United States are bonds that are backed by the United States government, making them nearly risk-free. Governments and enterprises both issue bonds to raise funds for projects and operations. Because there is a greater danger of a firm defaulting on the loan, corporate bonds are slightly riskier than government bonds. Unlike buying stock in a company, buying a corporate bond does not offer you any ownership in that company. Number 5. Mutual funds. A mutual fund is a form of investment fund run by a money manager that manages your money and invests it for you in the hopes of making a profit. Mutual funds are often made up of a mix of stocks and bonds, but because your money is spread across numerous equities and bonds, they carry less risk. Stock dividends and bond interests are the only ways to profit unless you sell when the fund's value rises with the market. While mutual funds are developed and managed by so-called financial experts, they often have a hard time surpassing the market in terms of value, especially when fees charged by money managers to individuals who invest in their funds are taken into account. Number 6. Index funds. Index funds, like mutual funds, are a sort of stock investment that diversifies your portfolio over several stocks. Index funds differ from mutual funds in that they are not managed by a money manager and are instead passively managed. Because index funds are handled passively, there are fewer costs, which means you can expect somewhat higher returns than you would with a mutual fund. On the other hand, your returns will be entirely dependent on how well the index your fund tracks performs. Given that most main indexes are used to measure the general movement of the market, indexes, in the long run, perform roughly as well as the total market. In other words, they typically generate an annual return of around 7%. Investing in an index is like putting your money into the future of the United States. If you believe the American economy will continue to grow, you'll probably be okay. Number 7. ETFs. Exchange-traded funds, or ETFs for short, are similar to index funds in that they monitor and duplicate the performance of a popular index. ETFs, unlike index funds, are purchased and sold on the stock market. You will have more influence over the price you pay for ETFs because they are traded on the stock market, and you will pay fewer fees. Your return is entirely determined by how well or poorly the index in which you invest performs. Investing in an ETF that tracks a wide index, such as the S&P 500, can help you reduce your risk. Number 8. Individual stocks. Stocks are shares of a corporation's ownership. When you buy stock in a corporation, you become a partial owner of that corporation. That means that if the firm generates money, so do you. And if the firm's worth rises, so does the value of your shares. When a company's stock price rises, so do the value of the owner's investments in that company. The stock can then be sold for a profit by the owner. However, when the price of a company's stock falls, so does the value of the owner's investment. If the corporation chooses to allocate earnings to its shareholders, stockholders can also benefit from dividends. The stock market as a whole rises at a pace of roughly 7% per year on average, but investing in hand-selected individual companies can yield substantially larger profits. Number 9. Stock options. When you buy a stock option in a firm, you're wagering on whether the stock price will rise or fall. Without actually holding the stock, you can purchase or sell shares of that business at a specified price within a specific term by purchasing an option. Options are quite dangerous. There is the potential for big returns, as with most high-risk investments, but there is also the potential for significant losses, especially if you don't know what you're doing. Put options. A put option commits you to sell a stock when it reaches a specified price at a specific time. A call option commits you to buy a stock at a specified price and at a certain time. Puts provide you with the right to sell a stock at a predetermined price, and they normally grow in value when the underlying stock's price falls. Call options. Call options carry a premium, also known as a market price. To acquire the contract to buy the underlying stock, you pay the call option premium. Investing in call options is a great strategy to produce income flow, while also lowering the basis on the firms you already own. Number 10. 401k and IRA. A 401k is a type of retirement plan provided by your company. The main advantage of this retirement option is that your company may provide a match, which means that they will contribute the same amount of money to your account as you do, up to a specified percentage. 401ks often have a restricted number of investment options, the majority of which are mutual funds, which implies your retirement savings will be constrained. IRA. An individual retirement account, or IRA, is one that you can open for yourself. There are two types of IRAs, traditional and Roth. Traditional IRAs are tax deferred, while Roth IRAs are tax-free. Did you hear what I said? A Roth IRA is a tax-free investment vehicle. Because the money you put into a Roth IRA is taxed before it's invested, you won't be taxed on the income from your investments when you withdraw it during retirement. You have more choice over where your money is invested with an IRA and a Roth IRA than you have with a 401k. You can invest the money in individual stocks, bonds, ETFs, and mutual funds in these accounts. Keep in mind that low-risk investments typically yield modest returns. That is unquestionably the case with several of these investment options. Thanks for watching.